Joining us right now is former Dallas Fed President Richard Fisher. He is a senior advisor to Barclays. He serves on the boards of Tenet Healthcare and Warner Brothers Discovery, and he's a CNBC contributor. And Richard, welcome. First of all, let's just talk about what this means with the Fed. We keep thinking the Fed is trying to get out of the way, trying to get out of the picture a little bit, but it is still the biggest thing that's moving the markets right now.
Yeah, the Fed is to money what Georgia is to football. And I take Mary and Mr. Bostic seriously. They're both highly regarded within the FOMC. And I know Mary's held in very, very high regard, as is Raphael. So what they were saying is they expect to sort of a toss-up between 25 and 50 basis points. We'll see what the CPI does. But I think the important thing of what they were saying, particularly Mary, is the Fed funds rate's likely to end up above 5%. And I don't know if the markets fully discount that yet. So, Becky, we'll just have to see. I would say the following, and I've said this several times now. The Fed does not want to do two errors in a row. They blew it on the transitory argument. They're embarrassed by it. And the last thing they want is to make a second mistake, which is to stop too soon. And are they likely to go too far? Yes.
Wouldn't that be a mistake too? I mean, isn't that a mistake either way, going too far or stopping too soon?
Well, yes, but they also have an institutional memory. You know, we go back to the 1929, 1928 period when the Fed, as it was then, basically the New York Fed, raised what was known as a rediscount rate, took it from a little over 3 up to 6%, and in real terms 7% by early 1929. That killed the market, created a panic, and killed the economy. We know what ensued. They're well aware of what history has taught them, but at the same time, the principal job of any central bank is to slay the inflation dragon, and they want to make sure they've done it. They're bringing it back to 2%. They're not going to change that target despite what some people speculate. And again, Mary Daly made clear yesterday. And they still have a ways to go. We'll see how much is being improved on the services sector side, but employment is still very strong. And what Powell refers to as the core measurement still is running pretty rich. And they're just going to have to make sure they've dealt with that issue.
Hey, Richard, the meeting minutes that we got last week from the December meeting did seem to suggest that there's a little bit of dissension in the ranks at the Fed. At least there was an argument that went back and forth about what's worse, hurting poor people because of unemployment or hurting poor people because of inflation. They're both pretty terrible.
Yeah. Right now, they're hurting investors. We're still going back to an adjustment process of a whole generation that was used to cost-free money. And now they have to look at the long-term future differently against a hurdle rate. When you have the 2-year Treasury or 5-year Treasury where it is, even though they've come down a little bit, you still have a comparative cost. And you discount future cash flows and profits against a different hurdle than you were before, and you got so used to forever for an entire generation of investors. So I don't think that adjustment is gone. I expect to see continued volatility this year. And I would not be smug about the thought that the Fed's going to abandon the 2% target or rates are just going to come back willy-nilly. It doesn't work that way. And they're determined to make sure, again, they squeeze all impulses for inflation out of the system.